Okay, we are off to the races. The Friday session has begun, and we are coming to the end of April. And I would say we're still looking at an uncertain story for investors. We see that with the economic data even here in Canada today. Cooling effects for the economy, still some inflation worries. The earnings story, somewhat mixed, although our Canadian market is putting up a positive performance to start the trading day. Let's bring in Ryan Bushell, who's President Portfolio Manager at Newhaven Asset Management. Always great to see you. I don't know, I feel like we're sort of stuck in a bit of a similar conversation right now, and investors have to decide what side of the fence they're landing on. What do you say about this current environment?
Yeah, I mean, it's a daily kind of come in one day, get an up day, come in the next day, get a down day.
Yeah.
That's what happens in a sideways market, right?
Yeah.
We've been in a sideways market since last June. Things kind of changed early last year when especially sort of Facebook was kind of the first shoe to drop, or very early last year, late 2021, and from there, we had a significant move down, and since then we've been in this tug of war back and forth on we get some strong data, we get some weak data, we get some strong inflation data, we get some weaker inflation data.
I mean, we love it because we can keep our audience interested in every new data point. What do you think is at the heart of a sideways market? Why we've been in one?
I think it's just there's a lot of uncertainty, and the economy, admittedly, I think has been stronger than I thought it would be. I thought that the interest rate hikes that have occurred would have bitten into the apple a little bit sooner, just because there's so much debt in the system, and it's just a law of kind of absolute numbers. Then you make the absolute number larger. Every increase of interest rate on that larger absolute number is more painful. But there's obviously some lag to that as well. All mortgages don't reset day one. All corporate debt refinancings don't happen as soon as the interest rate rises. So, we're in this kind of wait and see approach. And for us, what's really important is, and for our clients, is the dividends keep coming in. And so in a dividend-based strategy, this is why we feel pretty confident on owning infrastructure companies that are going to persevere through whatever is to come, whether it's positive or negative. If it's positive, there's going to be more economic development, more need for infrastructure. If it's negative to sideways, there's still a lot of work that needs to be done in North America, especially as it relates to power demand and electricity usage. So, we're trying to hedge our bets or trying to be protected for clients either way.
Well, I think the reality with investing is that there are thematic reasons why investors get excited about different sectors, right? Like part of the argument for investing in that group this year has been AI. What does it mean? Who are going to be the winners? Some of that is kind of like the economy. We don't quite know, but people are placing those early bets. But we just spoke with David Weston from Bloomberg, who's going to be sitting down with Prime Minister Justin Trudeau later today. And we have both Canada and the U.S. who are vying for new business. They're building new facilities to accommodate that new business. You must be watching that closely because you're the infrastructure guy.
Yeah, and I sent over an article earlier that there's a lot happening on trying to re-procure manufacturing activity back to North America. And so, we saw this with the Fed's announcement on the battery plant for Volkswagen, right? A huge investment there by our government to get that plant approved in Canada, basically outbidding the U.S. for it, sort of in a very layman's terms way. So there's a lot of competition out there, and there's a lot of things that need to be done to support that development, and a lot of it relates to power demand. We're seeing an inflection higher in power demand anyways, just based on electrification of transport, cloud computing, and population growth. Any retrenchment or just gains in manufacturing or other large power usage factories and outputs is going to be incremental to that. And we've got a system that has been kind of flat to down in terms of total power usage for quite some time. And it's in need of, one, repair, and two, expansion.
Okay, let's go through, on that note, some of the stock ideas you've brought to the table, because I know people are always curious, whether it's here or on Market Call, and what you have to say. We've got Brookfield Renewable, Fortis, TC Energy on your list today. Common theme there?
Yeah, so the common theme is electricity demand. So you're going from kind of the source or the wellhead in TC Energy's case, transporting natural gas, which again, natural gas is an important part of the power generation mix, as much as we would not like it not to be. Globally, I read another article, India's power usage went up by 13% last year. The coal-fired share...
Biggest population in the world now.
That's right. The coal-fired share of that power generation went up last year. So that means not only did they have to add power, but even within their existing mix, it went more towards coal because LNG cargoes got taken away from them, bid away from them by Europe, who was in need of replenishing their gas reservoirs ahead of winter, right? So TC, you know, with a growing energy demand case, not only in North America, but globally, especially with the gas that's being prepared for export off the west coast of Canada, looks pretty good to me. They're the only company that can move a molecule of gas from British Columbia to Mexico and hitting almost all points in between. So it's a pretty powerful company when it comes to that.
And I know this is a question that probably would be worthy of more time, but we don't have too much time. How much of your investment conviction is based around stock appreciation and how much is directly tied to the dividend story?
Yeah, so it's mostly dividend, right? So for all three of these names, you're getting kind of 4 to 6% dividend yield. And our total return assumption, until we see what happens with inflation, if inflation really does settle in at 3, 4, 5%, then we're going to be looking for more capital appreciation. But for now, if we do go back to kind of a low growth, low inflation world, which was the case prior to 2021, you're looking at a 6% return, 6 to 8% return. 6% of that return in TC is coming from the dividend.
All right, Brian.